Rey Delio, uno de los mejores inversores de la historia con un patrimonio aproximado de 19.000 millones de dólares, después de un año ha vuelto a conceder una entrevista para el canal de bilyeu. Delio ha estado alarmando sobre la teoría del ciclo económico, y en más de una ocasión ha hablado sobre el crecimiento y caída de los grandes imperios que producen un nuevo orden mundial, pero en esta ocasión, tras haber estudiado más de 500 años de historia, viene a avisarnos que estamos terminando la fase 5 del cuadrante de la caída de los grandes imperios, y según él, el primer síntoma son las quiebras bancarias, algo que ha dejado a todo el mundo atónito. Presta atención a sus declaraciones.
And now we're again seeing this cycle repeat itself. So I've heard you say that we're in somewhere in phase 5, which is as the empire begins to decline, as you have a rising superpower, as the debt bubble is getting out of control. With that perspective, was what happened with the SVB bank collapse, was that something that you knew, okay, something like that is coming, or was that a surprise to you?
No, it was obvious. Look, if you just I want to talk about the mechanics, really. I'm so eager to pass along an understanding of the mechanics so people themselves can do the analysis. So one man's debts are another man's assets. Okay, so what happened? The government had to sell a lot of debt. And when it sold a lot of debt, there were a lot of entities that bought a lot of bonds, government bonds. And money was very easy, which meant that short-term interest rates were very low. And money was actually being given away because they had interest-only loans and interest rates were less than 1%, and you didn't have to pay back principal. So you could go get money. And so that created a lot of debt, and it created a lot of buying of government bonds. So what happened to Silicon Valley Bank is what happened to many entities all around the world, not just banks. They what does a bank do? A bank takes in deposits, typically, or debt in some way, and then it buys debt. It can do that in the form of making a loan, or it could do that in the form of buying a government bond, buying debt. And then when interest rates went up, the value of that debt went down. The money they had to give to depositors became more and more expensive. And also depositors, wanting them to be competitive, looked at money market rates or other rates and withdrew money from the bank because they had better uses. Okay, so what that leaves them with, it's a banking problem that has happened literally for thousands of years, that what they do is the depositors, want their money back, and they're holding assets that are, in this case, have gone down in value, so they're broke.
Requests for people's deposits back are coming at a reasonable rate, all is well. But when you get a lot of people coming at once and you have the investments that they've made have gone down in value, now you get a perfect storm.
Exactly. I think you said it very well. You're allowed to be in the business. Let's call it 1/10. It's actually less than 1/10 is your money.
Whoa.
But let's call it 1/10. You have a certain amount of money up. They give you the deposits. You invest the money within these general guidelines. So, for example, government bonds are safe from default. So you buy the government bonds. You think you're making a spread. And then what happens is the government bonds go down in value at the same time as the people say, hey, I want to go take my money and put it someplace else. So you don't have enough money. And central banking works like that, except the government can print the money. So the risk, and when it's the government, is not that you won't get the money back unless, like in this particular case, for a bank, it goes down in value. So you ain't going to get that back. You're going to sell it. But anyway, you described it very well. What happens for the economy as a whole is then they print the money because they don't want defaults. There's a tolerable amount of defaults, and then you get past a tolerable amount of defaults and it just crushes everything. And so they print the money. Okay. And so this thing with the bank is not a Silicon Valley Bank is a loan issue. It's not a banking issue. It is a global issue in terms of all around the world. all sorts of entities, pension funds, insurance companies, all around the world. There was a lot of the buying of these government bonds, which have gone down in value. And if you then take it and you say, what's the value of those? Those have gone down. And the cost of money is high. And so the world is leverage long, okay? Long, meaning they own stuff and they borrowed money to own it, and it's going down in value.
Even if you took every dollar that our entire country makes, I think it's true globally. If you took every dollar that we make globally and tried to pay off the debt, you wouldn't be able to do it.
Well, that's right. But it's not expected to pay it off in a year.
Sure.
I want to go back to my main point to make this clear. If you're holding that debt, you are holding something that money will come back. Let's say the government can print the money, but if the money's hard, if that's going to be good money that's coming back, it's going to be hard for those entities to pay back because it's a lot relative to their income and cash flows to pay it. And that means that the default risk rises. However, because you're holding that, it means that the debt will be bad one way or another. It's either bad because they don't pay it and needs a haircut for them to pay it, or because they do pay it with money that is going to be printed to come back. So when you look at that, and that problem occurs when there's a lot of debt assets and a lot of debt liabilities. So think of it this way. Just want to make this clear. When there was the position that interest rates got a lot below the inflation rate, you're losing buying power. There's no good reason to own that. And there's a change in psychology because before there was, I own bonds. The bonds go up in value as interest rates go down. So I'm getting a price appreciation, even though I'm getting, let's say a low interest rate, but inflation isn't a problem until it's a problem. Then when it's a problem, because they print so much money and they put it out, then inflation goes up and a light bulb goes off. That light bulb used to be, okay, how much am I earning? Okay, I'm not earning much, but it's okay. The price of the bond or whatever's gone up, but anyway, I'm holding it and it's safe. And then people realize it's not safe because I'm losing money to inflation. So now you have the central bank wanting to rectify that imbalance by, real interest rates were minus 1.7%.
Meaning that inflation was chipping away at your buying power.
Yes, if I look at inflation index bonds as an indicator, or other indicators, I'm losing percentage points to inflation by holding that bond. And then when and people realize that, well, you don't want to do that. And then the other side of it was you want to buy and borrow and buy stuff because, money's free. So companies borrow and buy stuff and individuals borrow and buy houses because interest only loans on the houses. I mean, okay, I can buy a house, I can buy an apartment. And so, but that creates the imbalance where it's terrible to be a lender and a creditor, and it's good to be a borrower and do that. So that imbalance takes place. It produces inflation, and then when it produces inflation and so on, and then you say, I don't want to own these things anymore. And then and also the Federal Reserve says, I better fight inflation. They change things, and so by raising interest rates to levels in which it goes from minus 1.7% in inflation index bonds to plus 1.7%. And it makes it, and it raises the short-term interest rates, real interest rates much higher. Then, lo and behold, all the people who did all those things get hurt, okay? They borrowed, they bought the bonds, they bought all of those things and all of those debt instruments. And also companies, look at the companies that are affected. Because yields got so low, tech companies and others, those who have a dream, they don't have to necessarily make profits. They're selling a dream and the money's got to be invested. And so you see all of that change radically when that tightening of monetary policy. So now you sit there and have a lows. So when you're looking at the big picture, think of it as all like banking. You're holding all these financial assets. What is the value of a financial asset? It has no intrinsic value. Its only value is what it can buy. But there are many, many more financial assets out there, the most financial assets out there that there's ever been relative to the value of stuff to buy. There's too many claims out there. It's like musical chairs. Okay, if everybody says, "Oh, wait a second, let me get my stuff. Let me convert my debt assets. And I want to get my stuff. I want to get real stuff." That's a real problem. And so that's the global picture on the first of those 5 influences, right? The fact that it's happening with the other influences is very important because they affect each other. So this financial picture, by the way, is the same as in the 1930 to 45 period and the same as they were throughout history.